We're diving into a topic today that sits right at the center of modern finance: decentralized finance mastery. We know you, the learner, need to grasp the core concepts quickly, thoroughly, but we are not stopping there. We're tackling the central paradox of this entire ecosystem. How do you get financial freedom with decentralized tools if, spending that money means using powerful, centralized gatekeepers?
That paradox is absolutely the crux of it. And for this deep dive, we've gathered a phenomenal stack of sources. We have an academic educational framework, a really comprehensive 2026 DeFi roadmap for beginners, and a specific detailed case study on a B2B crypto to fiat bridge solution called PintoPay.
Okay, so our mission today is threefold. First, we distill the foundational concepts of DeFi. Second, analyze the tangible, practical ways you can spend crypto like cash in the real world. And finally, give you a sharp framework for evaluating the infrastructure options available right now, which means setting realistic expectations, right? Acknowledging the huge potential, but also the crucial limitations.
Exactly. We need to give you the critical lens for mastery, not just a list of definitions. It's a framework for decision making. We have to show what works, how it works, and precisely where the unavoidable compromises and, frankly, the risks are.
Okay, let's unpack this. Let's start with the big question. DeFi's been a buzzword for years, but why is this the year that, securing mastery really matters?
Well, it's not just about the tech anymore. It's about accessibility and control. The sources frame DeFi as fundamentally about taking back control of your financial future. It's about disintermediating, the traditional banks and brokers. And in 2026, the systems are mature enough that they're offering real, high-functioning alternatives for borrowing, saving, and trading.
And the mechanism that lets us get rid of the bank is the smart contract. The roadmap we have defines the essential functions of DeFi using these three core components, or the pillars of DeFi. So what are they, and how does the smart contract make it possible without a middleman?
The three pillars are lending, borrowing, and trading. In let's say, the traditional world, if you deposit money, the bank is the intermediary. They decide who gets the loan, they take a big cut. In DeFi, users interact directly with these automated smart contracts.
So when I'm lending, who am I actually trusting?
That's the key. You're not trusting a person or a company, you're trusting the code. The genius of the smart contract is that all the rules, the loan, the interest rate, the repayment terms, they're all pre-written, public, and non-negotiable. They just execute automatically on the blockchain. You supply crypto assets to a lending pool, and the code makes sure you earn interest from borrowers.
Okay, and borrowing works the same way, just in reverse.
Basically, yes. Borrowing requires you to put up your crypto as collateral, and the smart contract automatically liquidates that collateral if your position falls below a certain ratio. It's all about transparency and immutability. That's the core benefit over traditional finance.
That transparency is key. But because the code is the bank, it also means you're responsible for custody. The tools you use are absolutely critical. Absolutely. The roadmap really emphasizes that the essential tools to get started are all centered on secure self-custody. The various DeFi wallets. If you are your own bank, you have to master security. If you lose your keys, there's no customer service line to call to get your funds back. That is the fundamental trade-off for this financial freedom.
Right. And that brings us to maybe the biggest friction point for anyone new to this space: volatility. How do you integrate decentralized finance into your life when the value of your assets can swing so wildly, overnight?
This is exactly why stablecoins are so essential. The roadmap has this great phrase for them: a safe haven in volatility. And they really are the bridge between the Wild West of crypto and the stability of the traditional economy.
How do they actually function to maintain that safe haven status? What's the mechanism? They're assets designed to maintain a stable value. Most of them are pegged one-to-one to a fiat currency, like the US dollar. They let users get the benefits of the speed and transparency of DeFi, using them in lending, borrowing, all of that, without subjecting their principal to the huge price swings of, say, Bitcoin or Ethereum. You can lock in profits, you can hedge against market dips, and crucially, you can use them as collateral or liquidity because their value is predictable.
Okay, this is where it gets really interesting for me. Turning those assets into consistent revenue. If I'm not actively trading digital assets every single day, how can I generate reliable passive income in this ecosystem? The roadmap details two main methods: yield farming and staking. They sound similar. Both involve locking up assets, but the complexity and the risk profiles seem totally different.
They are often confused. But yeah, the distinction is vital for anyone who's aiming for mastery. Staking is generally the simpler, more passive strategy. You lock up your tokens to support the operations and the security of a specific blockchain network, specifically a proof-of-stake network. In return, the protocol pays you new tokens as a reward for helping secure the system. It's passive income, but your liquidity is often sacrificed.
That's the catch, isn't it? Simplicity comes with a trade-off. If staking is simpler, why isn't everyone just choosing it over farming?
Because of that sacrifice of liquidity. Staking usually requires a defined, often pretty long lockup period. You just can't touch those funds if you need them instantly. Yield farming, on the other hand, is the more complex, higher risk, and definitely more active strategy. It involves providing liquidity, often a pair of tokens, to decentralized exchanges or DEXs or lending protocols. You're basically lending your funds to help other people trade or borrow, and you earn commissions and maybe some additional governance tokens as rewards.
So yield farming is more flexible on timing, but what's the inherent risk that makes it so much more complex?
The complexity is all in managing risk, specifically a concept called impermanent loss. If the price ratio between the two tokens you provide to the liquidity pool changes significantly, you can actually end up with less dollar value than if you had just held the two tokens separately in your wallet. So farming requires constant active management. You have to monitor pool health, mitigate that specific risk, whereas staking is generally like a set and forget process, even if it is a liquid.
And the trading itself, the third pillar, that all happens on these decentralized exchanges, DEXs. This is where that true peer-to-peer nature of DeFi really comes to lay.
Exactly. DEXs let users trade directly with one another, or with those liquidity pools we just mentioned, without a central company holding the funds or executing the trade. No KYC, no account freezes. But that transparency and autonomy, as the roadmap reminds us, means you have to master security best practices. Autonomy means accountability for everything you do.
That's a vital reminder. So we've established how to earn and manage assets in the DeFi ecosystem. But moving from this abstract world of staked assets and yield farming payouts, we have to confront the biggest real-world hurdle: spending that money seamlessly. We need a bridge.
That's the critical transition. It's one thing to see a high APY on your screen. It's another thing entirely to use those assets to pay your rent or, buy coffee instantly. And this is where the case study of PintoPay comes in. It's a perfect example of the next-gen infrastructure that connects decentralized crypto earnings to traditional finance spending power.
So we're moving from the theory of financial freedom to the practical logistics. PintoPay is described as a secure neobank infrastructure. Can we clarify what that means in practical terms for you, our listener?
In short, it's a compliance layer and a conversion mechanism. PintoPay lets users spend crypto like cash instantly through familiar centralized channels like Apple Pay, Google Pay, or even physical cards. They handle the really complex, real-time logistics of converting crypto to fiat right at the point of sale, making sure the transaction is legal, fast, and compliant. They are the gatekeeper that gives your decentralized funds centralized utility.
And they aren't just handling the digital backend, they're issuing the tangible products we all use every day. They issue branded virtual and physical cards through major networks like Visa and MasterCard.
Correct. And the source material highlights this intense market competition, which is leading to less friction. We saw really clear evidence of this on the consumer side with their cost structure.
Now, we should probably mention those specific details because they really anchor this in reality for everyone.
Absolutely. The virtual card for Visa, linked to Apple Pay and Google Pay, initially had a card fee of $25 USDT. They dropped that fee to just $12 USDT.
That's a massive reduction, over 50%. That's not just a random number, is it? It tells a story about the market.
It signals market maturity, exactly. It means the infrastructure for KYC, for regulatory compliance, for card issuance, all that overhead that neobanks have, it's getting cheaper and more standardized, and they're passing those efficiencies to the user to get more adoption. Similarly, the deposit fee, what you pay to top up the card, that dropped from 2% to 1.5%. And this whole infrastructure is flexible. It supports both crypto and fiat top-ups, which is essential for usability.
Okay, now let's shift to the B2B side, which aligns perfectly with our goal of giving you a decision-making framework. This isn't just about end-user cards. It's about the infrastructure that other businesses can use to offer these services to their clients. So what does this all mean for how other projects are actually built?
It means we're looking at the logistics business model. And to show their scale and why they're a viable partner, PintoPay reports some pretty impressive metrics. 117,250 total users, with 38,000 monthly active users and 12,500 daily active users. And crucially for this B2B discussion, they report over 11 new business integrations every month. They're actively positioning themselves as the go-to infrastructure provider for issuing Visa and MasterCard cards via API.
The source material lays out two very distinct partnership models for businesses looking to integrate this. Let's really analyze the cost versus control trade-offs between their API solution and the white label solution.
Okay, so the API solution is tailored for more sophisticated projects. Fintech companies, larger DAOs, or crypto wallets that already have their own dev teams and an existing client infrastructure, they just need the technical pipe to issue the cards. The cost for that is $9,500.
That's the cheapest route, but the trade-off is pretty significant. You're basically just getting the tech stack right. No frills.
Exactly. You get no built-in client interface, no branding. It's purely a technical integration. And your technical support is limited to L2.
We should probably unpack that jargon. For our listener who's trying to achieve mastery, when we say L1 and L2 support, what does that actually mean for the business owner?
Right. L1 support is level 1. That's your frontline user-facing support. It's the customer service line your users call when their card doesn't work. L2 support is level 2. That's dedicated technical support for the integration itself. If the API is failing or the dev team needs help, that's L2. So by only offering L2 support with the API solution, PintoPay is basically saying, we provide the pipe, but you have to handle all your own user problems.
That clarifies the API model perfectly. Low cost, high control, but also a high operational burden on the partner. So now let's look at the white label solution. It's way more expensive, $30,500. Why would a company pay that massive premium?
They're paying for speed and for a reduced regulatory burden. The white label solution is the ready-made solution from the box. For that higher investment, you get the full package. You get custom branding, a built-in client interface, which can even include pre-built things like a Telegram mini app, and full support, covering both L1 for your users and L2 for your tech team.
So if the API is, what, $21,000 cheaper, the company choosing white label is really just buying time to market and regulatory ease. They can launch their own branded card ecosystem in weeks, not months, and sidestep a ton of compliance and development work.
That is the critical insight. The cost difference isn't just about a logo. It's about shifting that immense compliance burden, the licensing, the regulatory filings, the monitoring onto the infrastructure provider. The white label solution lets a crypto project focus entirely on its core product while instantly offering a globally compliant spending solution.
And the incentive for these partners to take on either option is crystal clear. A new, measurable revenue stream.
Precisely. Partners earn from every single card issued and topped up. The revenue forecast they provide highlights a really clear financial model based on a pretty moderate scenario of, say, 1,000 users spending $1,000 a month. That's $1 million in volume. The partner can expect $10,000 to $20,000 in monthly income, all based on a 1-2% commission share. This financial incentive is what's driving this rapid integration we're seeing.
This analysis gives us the ideal framework for evaluation. We've really gone from abstract DeFi concepts like understanding the risks of impermanent loss and yield farming to the concrete infrastructure of issuing a fully compliant branded MasterCard or Visa via an API or a white label solution.
And that brings us full circle to the educational principle we started with. There is no single best option. The choice of solution depends entirely on the user or the business's specific needs, their internal resources, their appetite for operational burden. Do you have the developers and the regulatory team to manage the low-cost API, or do you need the speed and reduced liability of the white label solution? You have to consciously consider the implications of centralization versus decentralization when you choose these tools.
We began this deep dive talking about financial control, about removing intermediaries to gain financial freedom. Yet, we have firmly established that for mass adoption, for you to be able to buy lunch with your staked crypto yield, you must leverage powerful, centralized, traditional finance entities, Visa, MasterCard, and the neobank infrastructure underneath it all. So as you integrate this new knowledge into your framework for DeFi mastery, here's a final provocative thought for you to mull over. If decentralized finance seeks to remove intermediaries, yet mass adoption requires leveraging these powerful centralized entities for real-world spending, where does true financial control ultimately reside in this emerging ecosystem? Is it in the autonomous code, or is it in the corporate networks that enable the spending? Think about the implications of relying on that bridge.